Moving on, FDI inflows in India are expected to see a robust growth in 2026, supported by strong macroeconomic fundamentals, big-ticket investment announcements, and sustained effort to improve the ease of doing business and a new generation of investment-linked trade pacts.
Exactly, and to ensure India remains an attractive and investor-friendly destination, the government has been reviewing its FDI policy and engaging in extensive consultations with key stakeholders. Now, to help us navigate and to understand India's trade narrative, our next session is really important and it's going to be really interesting also, Shibani. I'd like to invite up the moderator first. We'd like to have Aisha Faridi back on stage, and she'll be in conversation with Mr. Mahesh Nandurkar. He's the head of India Research and the India Equities Strategist at Jefferies.
Thanks, Shibani and Sumit. Well, we've heard so much talk about where to invest, how to invest, and I thought who better than Mahesh Nandurkar to tell us. And the debate is really not about what in equities, it's now about which asset class, gold and silver. And that's really confusing just about every investor right now. There's so much FOMO feeling as well, Mahesh, out there about, whether or not you can still make money, and that kind of money that all through you made in 2025 in gold and silver. I know I'm deviating from what we were supposed to discuss, but I have to get your thoughts on this.
First of all, thank you, Aisha, for inviting me for this program. So I think what the year 2025 did, or basically the last 15 months or so, I think just taught us the importance of the asset class diversification. The prior 3 or 4 years, or maybe 5 years, it was just one-way street. It was just one asset class that mattered, which was obviously the equities. But I think we just learned the importance of diversification. And I think the diversification should be viewed not just in the context of equities versus debt versus commodities, but also access to the international capital markets as well. And thankfully now we are sitting here in India, we have access to a variety of international capital market access products as well, offered by various mutual funds, and now we are seeing the GIFT City also is being made operational to that extent. So yeah, I think it makes sense, and it's was always known, it was always talked about, but I think people just forgot about the asset diversification in the previous 4 years. I think we are reminded of that once again.
Okay, interesting. So let me take it to a week back, the Budget Sunday firstly, Mahesh, and wanted your takeaways on whether or not, while budget is losing its significance over the years, and the government, to be fair, has done lots outside the budget in the year ahead already. But would you say that there was any drawdown or any takeaway that investors per se of equity markets or inequity markets could take from the budget this time?
No, I think what you're saying makes perfect sense, that in the overall scheme of things, and given the fact that budget is just one of the platforms that the government has to announce various reforms, various policy measures, and that's not the only one. So to that extent, I think we have seen some reduction in the investor anxiety around the budget time, and rightfully so, because obviously now we've got the GST implementation. There is a much more clarity on the indirect taxation. I mean, I remember like 10 years ago and 20 years ago, people would sit down with a pen and paper and we would get a big list of the excise duties on a whole bunch of products and commodities.
What becomes more expensive and what gets cheaper.
Exactly,
yeah.
Exactly. And thankfully with the GST implementation, that part is literally out, of the equation. And it's good that it is out of the equation. I mean, a country like India with, GDP of like $4 trillion and, growing strongly, we don't need this hanging sword every year that, okay, what's going to happen to my taxation on this product versus that product. So I think it's in a way, I would say a welcome thing that the budget has become a less of an event in terms of the changes in taxation, etc. goes. But yeah, but just to look at what we saw this Sunday or the last Sunday, I think it was a very, very pragmatic approach from the government. From my perspective, the simple takeaway was that over the last, say, 3-4 years, the government has been reducing the fiscal deficit at a rate of around 40 to 50 basis points per year. And this time, they have reduced the pace of fiscal consolidation to about 10 basis points per year. So from 4.4 of this year, targeting to 4.3% the year after. And that's a welcome change because at this point in time, we are going through a period of low nominal GDP growth, low inflation. And so to that extent, the government does have that flexibility to not focus so much on inflation and be a little bit more relaxed on fiscal. But having said that, they have cut the fiscal deficit target. So I think it's a welcome sort of change in the trajectory as such, although it means that in the subsequent year, there will be a tighter fiscal deficit reduction because they've already announced the March 31st debt to GDP ratio as the target. But yeah, so for now, I think that's one positive clearly from the budget. And the good news is that this incremental fiscal flexibility that the government has, they have basically used it to fund incremental capex than the other way around. So we have seen incremental budget allocation for roads capex, railways and defense capex. So I think all that is in a good stead. I think the market reaction on the negative side was probably emanating from the fact that there was certain quarters of the market that were expecting some kind of a relaxation on the capital gains taxation. That did not come through obviously, and we saw some incremental taxation coming in the form of STT. But I think in the overall scheme of things, it was a nice and pragmatic budget. The government rightfully focused on promoting exports, and we saw, as the previous speaker also highlighted, variety of ease of doing business related initiatives and the 21-year tax holiday for the data centers and the related activities. So I think it was a very finely balanced budget in my view.
You know, Mahesh, budgets will come and go, STT hikes will come and go, all of it will happen. But eventually for an investor, it's going to boil down to earnings because that's what the market will value. You've always believed that right now as we see it, given that macros are in a good shape, earnings will provide a cushion to valuations. How do you see the earnings trajectory pan out from here onwards?
No, that's a great question, Aisha, because ultimately an average investor goes more by the market sentiments and doesn't focus as much on the PE multiples and the earnings growth. But that's what ultimately is the driver for FY26. I mean, we have seen the corporate earnings growth has been relatively on the weaker side. We are seeing about 7 to 8% corporate EPS growth in FY26. And my sense is that the depressed level of EPS growth this year is attributable to various factors, which according to me are going to be reversing next year. So we are clearly looking at a much stronger, about 12-13%, 13 to 14% EPS growth next year. And we believe that it is going to be driven by one, first of all, as I mentioned, the nominal GDP growth has been low this year. The inflation has been low this year. And as the RBI governor also said in the morning, the expectation is that the next year, FY27, inflation is going to be well over 4%. So that itself is going to increase the level of growth in the nominal terms. And while, one might think that, okay, inflation-driven EPS growth, I mean, what kind of an argument is this? But see, ultimately, do we ever talk about what is real corporate EPS growth? We never talk about that. Do we talk about what is your real wage growth? We don't talk about that. We always talk about, okay, did your salary go up by 10% or 5% or 20%?
Cash in hand, basically.
Cash
That's
in
what
hand.
matters.
Cash in hand,
Yeah.
exactly. So I think that is definitely going to be one reason. Second reason I would say is that the rate cut cycle has come towards an end. And the fact that we saw 125 basis point rate cut by the RBI over the last 12 months has had a big negative impact on the banking sector earnings growth as the net interest margin goes down. So from that perspective, the outlook for such a large part of the market, almost 25% of the market is banks, right? So they see the positive momentum coming through because of that. And the third factor is monsoons, in the sense that last year, as in like FY26, we had like super normal monsoon and an extended one at that. And while one would argue that the impact of excess monsoon or good monsoon is good on the Indian economy. That is correct. That really helps our farm incomes and rural incomes. But the way the economy is reflected in the stock market, which is by way of which companies are listed on the stock market side, the corporate EPS actually gets negatively impacted because the number of sectors, be it like power demand, which is linked to monsoons, then construction activity, cement production, steel production, and you've got the soft sort of drink sort of consumption goes down, the aircon demand goes down, etc., which has a much greater representation in stock markets today than before. And secondly, in the earlier, let's say like 10 years or so ago, the rising rural incomes were well captured in the markets by way of the consumer staple sector. Now that has become a much smaller part of the index. And secondly, I think many of these companies, they haven't really kept pace with the changing consumer preferences, even in rural India. So, you know, if the income levels for an average consumer in rural area goes up, they don't necessarily end up buying more soaps or shampoos or hair oil, etc. Even, you know, they buy like, you know, one more shirt or one more shoe, or maybe buy a bigger data packet, or maybe, you know, go to a parlor and things like that. So in many ways, the impact of very good monsoon on rising rural income is not captured by the markets. So I think that also reverses probably next year, assuming a normal monsoon. Although some of the initial weather forecasters are talking about El Nino conditions building up, which probably means that it's not going to be a normal monsoon, but maybe a below normal monsoon, which once again might be not so good news for the rural incomes, etc., but will be a good news for the corporate EPS growth. So yeah, so I'm quite optimistic on the corporate EPS growth improving materially next year.
But you know, the point that you were making, that a large part of the market is not reflecting what's happening really on ground. But tell me, if I were to just, you know, take the fisheye lens right now, and if I were to just look at the $22 billion of outflows that we've had from the FPIs and the FIs, and they continue to sell India, at a time when India is not cheap, per se, what is that telling you? And what will make them return to India?
So this is, you know, a question that, you know, all of us are debating quite a lot, because that seems to be one of the key driving factors for the market. I think so. Unlike the domestic investors, obviously the foreign investors have multiple choices and multiple options, right? And what has changed in the last 12 months to sort of 18 months is this massive investment theme which has been playing out globally, which is the AI, right? And what we're seeing is that even in the Asian context, and while one might say that most of the AI companies are based in the US, but even in the Asian context, the markets and the economies like Taiwan and Korea are hugely plugged into this AI economy, right? By way of the chips, you know, and the memory. And I think, you know, if you look at the earnings growth offered by the other markets like Korea and Taiwan, it's like fantastic. So in fact, if you just, you know, if I just give you like a, like 2-3 data points, Indian corporate EPS growth used to be at about 7 to 8 percentage point premium to the other Asian markets. If you look at last 10-year averages, what it has been in the last 2 years, rather than +8, it has been -7 or 8. And the projection also for the next couple of years is also similar, because you know, if you look at like one data point, like, you know, what is happening to the memory prices, they've gone up 4 times, which is hugely helping the economies and the companies in Korea and Taiwan, etc. So net conclusion is that, so as the point that you rightly mentioned, that India is still about 40 to 50% premium to the other regional markets. And while in the earlier period, that premium was very well justified because Indian EPS growth was much sharper than the rest of the region, but that's not the case right now. I mean, obviously, some part of this change is more cyclical once again, because it is to do with what is happening in the AI and the AI-related investment cycle, which is not going to remain as strong as it has been. But for now, clearly, the value versus growth equation looks much better for some of the other regional markets, and that's why the foreign investors, you know, have done what they've done. And my sense is that unless this AI frenzy cools down a little bit, difficult to see why the foreign investors will rush into Indian markets in a hurry.
So Mahesh, your base case Nifty target is still suggesting modest upside. I'm wondering what's the swing factor, and would it be a trade in, trade out from the FIIs where the anti-AI trade will play out and then you think India will emerge?
Yeah, so my sense is that if you, an average Indian investor also needs to focus on what is really happening in the AI world and what is really happening with the big names like the Googles and Meta and so on. And at some point in time, the global investors will begin to question the huge investments that is going into AI right now. I mean, just last week, Google actually upped its annual capex guidance from 120 billion to 180 billion dollars in 1 year. So at some point in time, the global investors will begin to question that, okay, you are spending $200 billion. Is it really driving enough returns? And at that point in time, I would say there will be some change in the preferences of a typical foreign investor. And yeah, my sense is that it's still going to take some time, but I'm quite sure that this change in the thinking of the global investors will happen sooner rather than later. So second half of the current calendar year should probably look much better, for India. But maybe for the next 1 to 2 quarters, we'll probably have to just contend with maybe just a sideways market movement, I guess.
The other thing I also wanted to talk about, Mahesh, was as you look back for the year, there was so much which was happening in the primary market. DIIs were putting in money in the markets in any case. Is it really fair to judge the market not doing anything? Because major part of the flows were going into outside the secondary market.
Yeah. Absolutely. So I think equity supply has been very strong, as you rightly mentioned. And we have seen equity supply of all types, right? I mean, it's not just the new companies coming up and listing in the form of IPOs, but also the existing companies doing a follow-on offerings and QIPs. But also equally, we have seen large private equity sort of exits. We've seen some promoter exits as well. And when I mean promoters, it's not just the domestic promoters. We have to look at the foreign promoters and the names like the BATs, the LGs, the Hyundais, and so on. So all of those put together, we have seen equity supply has been in the range of almost like $5 to $6 billion a month. So while we talk a lot about the SIP inflows and the stability of mutual fund flows, and now the insurance and the NPS and EPFO and everything is adding to the domestic flows, but a large part of that has just been going out of the market by way of all this equity supply. I think at least in the visible future, that supply is going to continue. Our interaction with the corporate sector and so on, I do see that equity supply to remain quite strong. And so to that extent, the large domestic inflows that we've been seeing, will probably get absorbed in this equity supply and, therefore may not necessarily result in the markets moving up in a material way.
So since you are predicting another 2 quarters of a sideways movement for the market, what will be that big kicker? And will eventually everything boil down to earnings? Because markets are a slave to earnings. And if so, where is it that you see the next profit pools getting created?
No, so you are absolutely right. Ultimately, we have to follow the earnings. And the sentiments and the PE rating can do only so much. And we've seen a lot of PE rating, by the way, over the last 5 years. So my sense is that as the market begins to see more confidence in the EPS growth improvement story, as I said, like last year or FY26 has not been a great year. FY27, as we move into like Q1, Q2, we should be looking at numbers moving up closer to like 13 to 15% and maybe more. I think that's when we will probably begin to see the markets reacting from which segments would be driving incremental earnings growth. So my sense is, as I mentioned, one is definitely banks, Overall, the NBFC sector, but banks should kind of dominate the part of earnings growth improvement story. I would say the other, somewhat neglected sectors, like even I would say like real estate, power utilities, I would say names like cement, which are not very large part of the market, but many of these stocks have corrected in a significant manner, and in a manner that probably tells you that the market investors are not really expecting much out of these sectors. So even a small positive surprise can actually be quite, can be sort of taken quite positively by the stock prices in these sectors. So so among the so-called neglected sectors, I would say, my picks will be like cement, power utilities, real estate, among the neglected sectors.
And what's a good AI trade? And is the route via data centers?
Yeah, so as far as India is concerned, at this point in time, we seem to be participating in this whole AI chain in that data center mode somewhat, although not in a very big way. In fact, the way one should be looking at the AI, if you look at the sort of various verticals or sort of various segments, one can easily classify into 5 different segments. One, the base layer, is probably the energy or the power utilities. The second is the chips manufacturing. The third is the cloud servicing and the data centers. The fourth is what we call as the large language models and what we typically call as AI, in layman's word, LLMs. And the fifth and the final was the application layer. Now, at this point in time, India is not really playing too much from the listed companies' perspective in these 5 segments, apart from the data centers, as you rightly mentioned. But again, if you look at, there are a couple of like small companies, but if you look at some of the large companies, the contribution coming in from the data center business or cloud servicing business at this point in time is very limited at this point in time. So that's why many foreign investors look at India as being at the receiving end of the AI, and that's why what we discussed in the beginning.
Mahesh, out of syllabus question, but active investing or passive investing, what will work in 2026?
I think India is a solid bottom-up market, in my view. It was so last year. I think it will be like that this year as well. So my sense is that the importance of picking up the right stocks and the right sector is going to be paramount. And in fact, actually, even if you look at the last, say, like even 3 to 5 years, and even when the markets were actually doing pretty well, our analysis shows that active funds, in India have actually delivered better returns than passive funds. Because as I mentioned, India is actually a very strong, a market with like very strong sort of bottom-up ideas, and themes work out quite well. And I think in a year like this, like CY26, which I think is more like a sideways kind of a market, I think it is going to be a great news for the fund managers who believe in bottom-up stock idea picking. And in that context, I definitely believe that active fund management or active funds should deliver better returns than the passives.
More trade in, trade out kind of stories or long haul stories?
I think the next 12 months will probably a trading market in my view, because as I said, the overall direction is going to be like flattish. So there will be certain times in which certain ideas and certain stocks might do well, but then might not do so well, maybe after a quarter or two. So it makes sense to keep, an eye on that and then trade in or trade out as the case might be.
I have to ask you about Saspocalypse. Took me, of course, long to practice how to pronounce it. But is the IT trade-in over?
Okay, that's a very strong question. I won't say it's over, because ultimately software and IT services is definitely going to be a significant part of even that, as I said, the top layer, the application layer, right? So that is still going to be there. But my sense is that the development that we've seen globally in AI has definitely dented the significance of some of these IT services business model, unless those are reinvented pretty quickly. So yeah, so my sense is that like IT services is like therefore a sector which is underweight in our portfolio, because what we believe is that it's a sector that is probably not going to deliver earnings growth in double digits. It's going to be a single digit earnings growth story. So in that context, I mean there could be some near-term rallies that some of these stocks might see or the sector might see due to some positioning related issues that okay, everybody's underweight and then some positive news comes and then the stocks move up. But if you look at from a 12-month view or a 24-month view, I will be underweight on IT services. Yeah.
Mahesh Nandurkar, thank you so much. So much food for thought today in the conversation. Pleasure speaking with you.
Thank you very much, Aisha. Thanks a lot.
Thanks.
Well, thank you so much, Mr. Nandurkar, for some of those striking insights, and especially the last word on IT. Well, I would request Aisha to present a token of appreciation to Mr. Nandurkar. And a huge round of applause, ladies and gentlemen.